Long-term investors beware. Short-term hype is taking over. Look, I need you to imagine something for a second. You've been diligently putting money into your index funds every month for the past 3 years. You've got your diversified portfolio, you're thinking long-term, you're doing everything the financial gurus tell you to do. And then, your coworker walks in one Monday morning and casually mentions they made $8,000 last week trading some AI stock they heard about on TikTok. Meanwhile, your portfolio is up, maybe 7% for the entire year? Be honest, doesn't that sting a little bit? My name is Auric, and I spend way too much time thinking about why smart people make terrible investment decisions. If you're someone who's trying to build real wealth but constantly feels like you're being left behind by everyone chasing the latest hot stock or crypto coin, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing. We're living through what I call the great patience crisis in investing, and I'm not being dramatic here. According to a 2024 study by Schwab, the average holding period for stocks has dropped from 8 years in the 1960s to just 5.5 months today. 5.5 months! That's not investing, that's just gambling with extra steps. But here's what most people don't realize. This shift isn't happening because people are suddenly smarter or have better information. It's happening because the entire financial ecosystem has been redesigned to reward short-term thinking. Let me show you exactly what I mean. Think about how you consume financial information right now. You probably follow some finance accounts on social media, maybe watch some YouTube videos, check your portfolio app a few times a week. Every single one of those touch points is screaming at you about what's hot right now. This stock is up 40% today. Everyone's buying this. You're missing out. It's constant, it's everywhere, and it's completely destroying your ability to think long-term. I was looking at Fidelity's data from last year, and they found that their most active traders, the ones making trades every few days, underperformed their buy and hold investors by an average of 6.5% annually. Let me put that in real numbers for you. If you started with $50,000 and made 6.5% less every year for 20 years compared to a simple buy and hold strategy, you'd end up with about $112,000 less. That's not a rounding error, that's a down payment on a house you just threw away because you couldn't sit still. Now, you might be thinking, okay, Auric, but what about all those people making money day trading? They can't all be losing. And you're right, they can't all be losing. But here's the math that nobody wants to talk about. According to a study published in the Review of Financial Studies, tracking 1.6 million day traders over a 15-year period in Taiwan, only 1% of day traders were able to predictably and reliably make money. 1%! And even those profitable traders, their returns weren't substantially better than just putting that money in an index fund without all the stress and time investment. Let me tell you what's actually happening here. The financial industry has figured out that engagement equals profit. Every time you open that trading app, every time you watch a market update, every time you trade, someone is making money off you. It's like social media, but instead of stealing your attention, they're stealing your retirement. The psychology behind this is fascinating and kind of terrifying. There's this concept in behavioral economics called hyperbolic discounting. Basically, our brains are wired to heavily prefer immediate rewards over delayed ones, even when the delayed reward is objectively much better. So that dopamine hit you get from seeing your meme stock up 15% today feels way better than the boring reality of your index fund compounding at 10% annually for 30 years, even though mathematically the second option will make you significantly wealthier. Here's where it gets really interesting. There was a famous study done by Fidelity where they looked at which accounts performed the best during the 2008 financial crisis. Want to guess who the top performers were? Dead people. No, seriously, the accounts that performed the best belonged to people who had literally died and therefore couldn't panic sell. The second best performers? People who had forgotten they even had accounts. The people who were actively managing their portfolios, reading the news, making smart tactical moves, they got crushed. Look, I'm not saying you should never look at your portfolio or that you shouldn't stay informed, but there's a massive difference between being informed and being reactive. and right now, the entire system is pushing you toward reactive. Let me give you a concrete example of how this plays out. In January 2023, everyone and their mother was talking about AI stocks after ChatGPT launched. NVIDIA was the hot ticket. If you bought NVIDIA in January 2023, you probably did incredibly well. But here's the question nobody asks. How many people who bought NVIDIA in January 2023 actually held it through the 30% drawdown in May, or the volatility in August? According to Robinhood's data, the average customer who bought NVIDIA in early 2023 sold within 11 weeks. They got shaken out by normal market volatility and missed the massive gains that came later. This is the real cost of short-term thinking. It's not just that you might buy high and sell low on any individual trade, it's that you're training yourself to be constantly reactive, constantly chasing, constantly second-guessing. You're building the exact opposite of the mycological muscle you need to build real wealth. Here's what most people don't realize about long-term investing. The hard part isn't picking the right stocks or timing the market. The hard part is doing absolutely nothing while everyone around you seems to be getting rich quick. That's the test, and most people are failing it right now. A JP Morgan study looked at investment returns over a 20-year period ending in 2020. The average investor made 3.6% annually. The S&P 500 made 9.8% annually. Same market, same time period. The only difference? Behavior. The average investor kept moving in and out, trying to time things, chasing performance. The index just sat there compounding. Let me break down what that difference actually means. If you invested $10,000 and got the average investor return of 3.6% for 20 years, you'd end up with about $20,000. If you got the market return of 9.8%, you'd end up with about $66,000. That's $46,000 left on the table just because you couldn't sit on your hands. Now, the people selling you on short-term trading will tell you about survivorship bias or that you could be the exception. And maybe you could be, but let's be realistic here. If you're watching this video on YouTube instead of managing a billion-dollar hedge fund, you're probably not in that 1% of people who can consistently beat the market through active trading. And that's okay, because you don't need to be. Here's the thing that drives me crazy. Wealth building isn't supposed to be exciting. Compound interest is boring. Dollar cost averaging is boring. Rebalancing your portfolio once a year is boring. But you know what is exciting? Having actual financial freedom in 20 years, instead of having a bunch of war stories about that one time you made 40% on a trade before giving it all back. The short-term hype isn't going anywhere. If anything, it's going to get worse as AI tools make it easier to trade, as social media gets better at triggering your FOMO, as new products come out designed to maximize your engagement. The only way to win is to opt out of the game entirely. Build your long-term portfolio, protect it from your own impulses, and let time do the heavy lifting. Because here's the truth nobody wants to hear. In 20 years, the people who got rich won't be the ones who had the best trading strategies or the hottest stock picks. They'll be the ones who did the boring work of consistently investing and then did the even harder work of doing nothing.